Now the topic before us is unpacking assumptions of money multiplier. The money multiplier formula. What is the money multiplier formula? We have already learnt that the money multiplier formula is 1 over reserve ratio. This is the money multiplier formula. This formula is based on some certain simplifying assumptions. What are those assumptions? These assumptions are banks fully keep their excess reserves to make new loans. What it means? We will understand the same one by one. Suppose $100 is deposited in the bank. Now the banks have to obey the orders of central bank in each and every country. Suppose the central bank has mandated that each bank has to keep 10% as reserve. So after keeping 10%, that is $10, the banks are left with $90. So they can use $90 as loans. So this is the first assumption, that the banks will fully utilize excess reserves. That is, these are the excess reserves. They will fully utilize these $90 as loans. They will give this amount as loans to another person. Now the second assumption, all loans get redeposited into the banking system. It means that the person to whom the loan was given of say $90, he will use it to purchase certain goods, to avail some services, or to pay off some debts, and he will spend all the money, and all this money will get redeposited into the banking system. That is, it will again come into the banking system. That is, the person receiving the loan amount will spend it, and the person who receives that amount of $90 will deposit the same back into his own bank. Now the third assumption is reserve requirements ratios remain constant. That is, this reserve requirement will always remain constant. If it is fixed 10%, it will remain so. So these are the three requirements. First is excess reserves will be fully used to make new loans, and the second is all loans will get redeposited into the banking system and reserve ratio will not change. However, these assumptions may not always hold true in the real world banking system, because it may be possible that banks may not give all this amount as loan. They will not give fully $90 as loan. It may be also possible that when the person who receives the loan of $90, when he spends the same, the other person who receives the same $90 may not deposit full amount in the bank. It may be possible that the person receiving this $90 after selling his goods may deposit only $80 in the bank. It may be possible that he keeps 10% $10 at his home in the form of cash and deposits only $80 in the bank. It is also possible that Reserve Bank changes the reserve requirement, keeping in view the economic conditions in the country. So these are the assumptions which, on the basis of which this money multiplier formula, that is the 1 over reserve ratio, is based. We hope you have understood these assumptions in a very simple manner. Thanks for watching. If you like our course, please spare some time to give a star rating to our course.